Welcome to Know What You Are Investing podcast, where we decode the world's top companies. What they do, how they grow, why it matters. Today's episode is all about Tesla and their Q2 2025 earnings recap.
Welcome to Know What You Are Investing Deep Dive. We decode the world's top companies, what they do, how they grow, why it matters. Today, we're taking a deep dive into Tesla's Q2 2025 earnings. And this wasn't just another quarterly report, was it? It felt packed with crucial updates, not just about their vehicle business, but really about a potential fundamental reshaping of their long-term vision. We're going to unpack the key financial results, the operational advancements, and, well, the truly ambitious future laid out by management.
That's absolutely right. And I think what's critical for you, the listener, to grasp is that this particular quarter, it really marks a pivotal moment for Tesla. It signals a profound shift in their strategic focus, moving well beyond just electric vehicles and energy into, entirely new and expansive territories like artificial intelligence and robotics.
Okay, let's unpack this monumental shift right away then, because, it was the dominant theme of the Q2 2025 earnings call. Elon Musk himself didn't really mince words, did he? He described this quarter as a seminal point for Tesla. He's openly framing it as the beginning of their evolution from, an EV and renewable energy leader to becoming a major, maybe the major, player in AI, robotics, and all the related services. That sounds like an enormous leap, doesn't it?
It's an audacious claim, certainly. What's particularly fascinating here is the sheer confidence, the optimism in Musk's outlook, especially regarding the successful launch of their Robotaxi service down in Austin. He highlighted that these were the first drives with no one in the driver's seat with paying customers in Austin. Pretty remarkable. He literally stated autonomy is the story that will amplify Tesla's value to stratospheric levels. In this narrative, it marks a stark contrast to previous quarters where the focus was often on, navigating supply chain resilience. Now it's firmly on tangible operational launches, things like Robotaxi and Optimus. This shift in narrative is just crucial for investors because it redefines what Tesla wants to be valued for. However, it's worth noting, CFO Vaibhav Taneja offered a much more tempered view, acknowledged some very real near-term headwinds.
Okay, Musk sounds incredibly bullish on robotaxi, stratospheric even. But you just mentioned the CFO had a more tempered view. Can you elaborate on that contrast? What exactly are those near-term headwinds that might be a reality check on Musk's grand vision?
Yeah, it's sort of the classic Musk versus the numbers scenario, isn't it? While Musk is painting this long-term AI-driven future, Taneja is, he's anchored in the immediate financial realities. The headwinds he referenced are primarily the declining vehicle deliveries, lower average selling prices for the cars, and the impact of expiring government incentives. Essentially, the core automotive business is facing challenges right now, and the AI and robotics ventures, while promising, they're in heavy investment phases. They're not yet generating substantial profit. So this creates a tension, right, between the long-term narrative and the short-term financial performance, which you, as an investor, absolutely need to understand.
Right, that makes sense. That brings us neatly to the financial impact of this pivot. So with all this ambition flying around, how did Tesla's core financial figures actually stack up in Q2 2025?
Well, the total revenue decreased 12% year over year, came in at $22.5 billion. And this isn't just a number. It fundamentally highlights the immediate trade-offs Tesla's making. As it shifts, from a volume-focused EV company to this AI and robotics play, it's a necessary dip in the road, maybe, for a potentially massive long-term gain. But it starkly shows the short-term pain of that transition. This decline was primarily impacted by, like I said, fewer vehicle deliveries, lower regulatory credit revenue, and a reduced average selling price, the ASP, for their vehicles, even when you exclude currency impacts. Despite this, their services and other revenue did see some growth, which is interesting. Specifically, automotive revenue was $16.66 billion. That's down 16% year over year.
Okay. This sounds like a tough quarter on the top line, no doubt about it. But what about profitability and cash flow, which are absolutely crucial for, any company's sustained health and ability to fund these ambitious projects?
Yeah, profitability also faced significant challenges. Operating income decreased 42% year over year, down to $2.9 billion.
42%. Wow.
Yeah, resulting in a pretty lean 4.1% operating margin. This was largely due to that lower regulatory credit revenue we mentioned, and a notable increase in operating expenses, driven by their significant investments in AI and other R&D projects. Now, while operating cash flow is a healthy $2.5 billion.
Okay.
Free cash flow stood at a much lower $0.1 million.
Only 0.1.
Yeah, representing a significant 89% year-over-year decrease.
89% drop in free cash flow. That's a stark number.
It is. While they're investing heavily in AI, that level of cash burn definitely raises flags, right?
Okay.
It basically means they're not generating enough cash from their current operations to cover their significant capital expenditures, which are also soaring.
And on that note, what exactly are those capital expenditures going towards? Where's the money going?
Right. So capital expenditures saw a rise to $2.39 billion for the quarter, with the full year expectation now in excess of $9 billion.
$9 billion plus.
Yeah, it's a massive outlay. It reflects their continued aggressive investments in AI infrastructure, the Cybercab project, which is their purpose-built autonomous vehicle.
Right, the dedicated one.
Exactly. The semi-truck line and just broader manufacturing expansion. It's also interesting to note, sequentially, automotive revenue actually increased 19%.
Oh, okay.
Despite only a 14% increase in deliveries, which they attributed to improved ASPs from the new Model Y.
Got it.
Oh, and adding a touch of volatility, they reported a $284 million gain from Bitcoin holdings in Q2, contrasting a loss in Q1.
Bitcoin. Always adds a twist.
Exactly. While it's a one-off, it highlights the speculative elements sometimes at play in Tesla's financials, a factor you might want to consider when evaluating the core operational performance.
Okay, so even with this massive AI and robotics push, the automotive business remains the core, at least for now. How did vehicle production and deliveries fare this quarter, especially thinking about inventory levels?
Well, total production was 410,234 units, which is basically flat year over year, while total deliveries were 384,122 units. That's down 13% year over year.
Down 13, yeah.
Yeah. And what's notable here is that global vehicle inventory also increased. It's now at 24 days of supply. That's up 33% year over year.
24 days. That's a noticeable increase.
It is, and it suggests they're producing more cars than they're currently selling, which, can put pressure on pricing and eventually cash flow.
Right. And on the product side, what about the much-anticipated new affordable model? Any updates there? And how's the Model Y performing?
Okay, so the first builds of the new affordable model actually began in June, with volume production slated for the second half of 2025 and wider availability by Q4 2025.
Still a little way off for volume.
Exactly. And the ramp is, quote, slower than initially expected. Management cited two main reasons for that. First, a focus on delivering as many Q3 vehicles as possible before that $7,500 IRA EV credit expires. That's a big incentive customers want to grab.
Understandable.
And second, just the inherent manufacturing complexity of bringing a completely new product to volume production. The goal, they emphasized, is to create an affordable car that everyone loves, but without negatively impacting revenue or gross margin.
A tricky balance.
The very tightrope walk, yeah. Meanwhile, the Model Y continues to be a strong performer globally. It's the best-selling car in Norway year to date, and it dominated sales in several key European markets like Turkey, the Netherlands, Switzerland, Austria in June. They also launched a new long-range rear-wheel drive Model Y in North America. 357 miles of range, priced under $45,000 before incentives.
Okay.
On the safety front, the refreshed Model 3 received 5-star ANCAP and Euro NCAP safety ratings. Good news there. A significant headwind, though, is that upcoming repeal of the U.S. IRA EV credit by the end of Q3 2025.
Right, that's coming soon.
Very soon. And a $300 million sequential increase in tariffs, which they expect to have, quote, full impact in the following quarters. This will undoubtedly impact vehicle affordability and demand going forward.
Okay, let's shift focus now. Let's talk about the part that truly captures the imagination, right? The part that fuels that stratospheric valuation talk. The Robotaxi service and Tesla's, frankly, audacious autonomous vision. When you talk about Robotaxi service launching with no one in the driver's seat with paying customers in Austin, it really sounds like science fiction made real. This feels like a huge milestone for them, doesn't it?
It absolutely is. A massive turning point, potentially. The Robotaxi service officially launched in Austin in June, and they're not stopping there. The service area in Austin is expanding substantially. Their, audacious goal is to cover half the population of the U.S. by the end of the year.
Half the U.S. population by year end.
That's the goal. Contingent, of course, on navigating the notoriously complex regulatory approvals in key areas like the Bay Area, Nevada, Arizona, Florida.
Big hurdles there.
Huge hurdles. They also achieved a world first with the autonomous delivery of a new production Model Y from the factory to a customer's home in Austin. A 30-minute drive, including highways, No human intervention? Yeah. And Tesla expects to deliver cars autonomously by default in the greater Austin and Bay Area by the end of this year.
That's quite the leap forward. So how is their full self-driving technology, FSD, progressing beneath the surface? And what are the timelines for wider adoption, especially, you mentioned maybe even in non-Tesla vehicles?
Yeah, so since the launch of FSD version 12 in North America, Tesla has observed a marked improvement. And also a 25% increase in FSD penetration rates. More people are opting in.
Okay, that's significant uptake.
It is. And their safety report even indicates that FSD is 10 times safer than non-FSD driving, which is a powerful statistic, right, for public perception and for regulatory bodies.
10 times safer.
That's the claim. However, the production release of FSD for broader markets is, quote, several months behind the specialized Robotaxi experience in Austin. But improvements are anticipated. Unsupervised FSD is targeted for incentivized personal use by the end of this year in certain geographies in the U.S.
Incentivized personal use, meaning owners could potentially earn money.
That's the idea. Getting paid to let your car operate autonomously sometimes. Looking further ahead, Tesla aims to allow non-Tesla vehicles to participate in the Robotaxi network next year.
Interesting. How would that work?
Well, they'll implement specific criteria for vetting these cars, presumably for safety and reliability standards. As for their own purpose-built autonomous vehicle, the Cybercab,
Right.
it's optimized for autonomy. Potential cost, they're saying, sub-$0.30 per mile.
30 cents a mile. That's incredibly low.
Staggeringly low cost for transport, yeah. And targeted volume production in 2026. Musk projects a material impact on our financials around the end of next year from these robotaxi operations.
Okay, but Tesla isn't just cars and robots, is it? Their energy business, often kind of overlooked, seems to be quietly becoming a cornerstone of their long-term strategy, especially when you think about the massive energy demands of AI. It seems like the literal power source for their ambitious future.
It absolutely is. The energy business is indeed crucial, not just as a revenue stream, but as foundational infrastructure. Tesla achieved its 12th consecutive quarterly record for energy storage deployments on a trailing 12-month basis, including record Powerwall deployments for the 5th consecutive quarter. So consistent growth there.
Steady growth, right?
And this growth isn't just about revenue, it's deeply strategic. The availability of clean, reliable energy is deemed, quote, necessary for economic growth and an imperative for the development and commercialization of AI-enabled products and services, especially since AI applications are very energy hungry.
Makes sense. All those GPUs need juice.
Exactly. Think of it. All those AI training centers, all those robots eventually, they need massive, reliable power. Megapack, in particular, helps increase the utilization of the electric grid by storing renewable energy, makes the whole system more stable and efficient. Financially, the energy business recorded its highest gross profit yet, reached $846 million.
Record profit there.
Yep. They've started deploying megapacks from their Shanghai megafactory, and they plan to launch a third megafactory near Houston in 2026. Alongside starting LFP cell manufacturing in the U.S. by year-end, bringing critical battery production in-house.
So more vertical integration.
Right.
Yeah.
However, like the automotive side, the one big bill, which refers to that whole package of policy changes and incentives, and tariffs are also impacting the energy business, particularly residential storage, due to the early expiration of consumer credits.
Okay. Now, for the really cutting-edge stuff, perhaps the most futuristic element, Tesla's advancements in core AI and robotics, specifically with the Optimus robot. This really sounds like something out of a blockbuster movie.
It definitely does, doesn't it? Tesla has significantly expanded its AI training compute, added an additional 16,000 H200 GPUs at Gigafactory Texas, bringing their Cortex, that's their supercomputer for AI training, to a total of 67,000 H100 equivalents.
That's a lot of compute power.
It's a massive, tangible investment in the raw processing power needed to train these complex AI models for FSD and for Optimus. Think of it as Tesla building its own sort of superbrain for its robots and autonomous systems. Regarding Optimus, Musk described Optimus 3 as an exquisite design with no significant flaws. High praise.
Optimus 3 already.
Yeah, they're targeting prototypes by year-end with scale production next year. and an incredibly ambitious goal to reach 1 million units a year as quickly as possible, potentially within 5 years.
1 million humanoid robots a year.
That's the target. What's compelling is that every part of Optimus is designed from physics-first principles,
Right.
meaning they're designing everything from the ground up based on fundamental laws, not just iterating on existing designs, aiming for true breakthroughs rather than just incremental improvements.
Right.
Musk even shared that the Optimus lab looks like the set of Westworld, with Optimus robots walking around the Palo Alto office 247.
Wow, okay. That's a vivid image.
A glimpse into a future that's rapidly becoming present.
Yeah. So we're talking about real, walking, learning robots already. That's incredible. And on the chip front, what's happening there to power all this intelligence?
Yes, very real progress, it seems. On the chip front, Dojo 2, their custom AI training chip, it's expected to operate at scale around 100,000 H100 equivalents sometime next year.
Okay.
And their spectacular AI5 chip, which will be for inference that's running the AI models in the cars and robots, is targeted for volume production by the end of next year. Apparently, it's so powerful that it might need to be nerfed or intentionally reduced in capability.
Nerfed, like in video games.
Exactly, for markets outside the U.S. due to export restrictions.
Interesting constraint.
Yeah. Musk asserted that Tesla is by far the best in the world at real-world AI and has the highest intelligence density of any AI. Bold claims. He also clarified that Tesla AI, focusing on these smaller, real-world models for vehicles and robots, is distinct from xAI. His other venture focused on, terabyte-scale models and artificial superintelligence.
Ah, good clarification.
Yeah, an important distinction for investors, addressing concerns about potential competition for resources or focus between the two.
Okay, so what does all this mean for Tesla's long-term outlook? Elon Musk has some pretty audacious claims about the company's future value, right? How does all this AI and robotics play into becoming the most valuable company in the world?
He certainly does have those claims. Musk firmly believes that if Tesla continues to execute well with vehicle autonomy and humanoid robot autonomy, it will be the most valuable company in the world. Full stop. The expectation here is a fundamental shift in their profit model. It's huge. The company anticipates that hardware-related profits from selling cars will be increasingly accompanied by an acceleration of AI, software, and fleet-based profits, from robotaxis, maybe Optimus services down the line.
So moving from selling a product to selling recurring services.
Exactly. That's the crucial distinction. From a financial impact perspective, Musk projects a material impact on our financials around the end of next year from autonomy. He anticipates very compelling economics for Tesla once you get to autonomy at scale in the second half of next year, certainly by the end of next year.
So really banking on late 2025, early 2026 for the financial payoff.
Seems like it. And a key part of this affordability strategy is the ability for owners to add their cars to the robotaxi fleet and earn money. Like in Airbnb, right? Expected next year in the U.S., dramatically increasing the affordability of Tesla vehicles for individual owners is the theory.
It sounds like Tesla's asking investors to put on their sci-fi glasses and look 5-10 years down the road.
That's a good way to put it. But for many, the immediate view of, declining revenue and rising capex might be a bit blurry.
Exactly. Let's shift gears then to the Q&A session with analysts. What were some of the main concerns, the probing questions, and how did management respond to these immediate challenges versus that, very long-term vision?
Yeah, analysts certainly had some pointed questions, trying to bridge that gap between today and tomorrow. One major theme was capital allocation, particularly given that high capex expectation, over $9 billion.
Right. Where's that funding coming from?
Exactly. CFO Vaibhav Taneja stated they would use the balance sheet in the interim for new initiatives. Then look to debt finance once recurring revenues from autonomy are actually established, which indicates, they are burning cash now with a plan to leverage future, still somewhat speculative, revenue streams.
Okay. Use cash now, bar later.
Basically. Regulatory timelines were another big area of concern. Questions about hurdles for unsupervised FSD and robotaxi expansion. Management acknowledged the, quote, Kafka-esque bureaucracy in Europe and challenges in China. But they expressed confidence in eventual approvals. We'll see. An interesting insight was the state of customer FSD education. Despite that increased FSD adoption with V12, apparently a vast majority of people, and even half of existing Tesla owners, haven't even tried FSD.
Half. Wow, that's surprising.
Isn't it? Management plans more prompts and education. But that's a critical internal hurdle they need to overcome for wider adoption, clearly.
That's a fascinating point, yeah. That a significant chunk of their own user base isn't even engaging with the tech they're banking their future on. What other key insights came out of the Q&A session?
Well, perhaps the most significant concern raised by an analyst, maybe the most controversial moment, was about Elon Musk's 13% ownership stake in Tesla.
Ah, right, that came up.
Yeah, especially given the world-changing nature of the technologies they're developing, like AI and robots. Musk reiterated this is a major concern for him personally and hopes it gets addressed, saying he didn't want so little control that I can easily be ousted by activist shareholders after having these army of humanoid robots.
Quite a statement.
It underscores his desire, maybe need, to maintain control over the long-term strategic direction. It's clearly on his mind. Other discussions touched on the lower-cost model's cost structure and, again, that clear separation of efforts between Tesla AI and XAI. And management also cautioned about a few rough quarters ahead.
Oh, which ones?
Specifically Q4, Q1, maybe Q2, due to the repeal of those U.S. incentives. Before autonomy truly scales and starts generating those stratospheric revenues he talked about.
So acknowledging the short-term pain is coming.
Explicitly signaling short-term volatility, yeah.
And so as Tesla races toward this AI-powered future, the question for every investor watching this deep dive isn't just if they'll get there, but maybe who will ultimately benefit most. Is it the early adopters, the long-term believers, or maybe the market itself? As the very definition of a car company completely reshapes before our eyes, what do you think?
That's the billion, maybe trillion-dollar question, isn't it? Look, the narrative has shifted decisively towards autonomy and robotics as the primary value drivers. That's clear. With concrete operational launches like Robotaxi and Austin now taking center stage, while management maintains this incredibly confident long-term vision, they've also become more explicit, I think, about near-term risks stemming from policy changes, the phase-out of incentives. So the key takeaway for you as an investor is really to weigh that ambitious long-term vision against the acknowledged short to medium-term volatility and the significant capital investment required to realize this AI-powered future. How Tesla manages to bridge this gap-scaling cutting-edge tech while optimizing traditional operations that will be absolutely crucial to watch in the coming quarters.
Thanks for listening to Know What You Are Investing Deep Dive. We decode the world's top companies, what they do, how they grow, why it matters.
Thanks for listening to Know What You Are Investing podcast, where we decode the world's top companies, what they do, how they grow, why it matters.